on the site or on the other medium. Just put your questions through, and somebody will pass them on to Shamubeel. All right. First, introduce myself, or on the other medium. Just put your questions through, and somebody will pass them on to. It's repeating myself. Sorry. So, Andrew Lance, I'm the Chief Investment Officer at Simplicity, and with me is our head of everything else, Shamubeel Eaqub, who mostly covers economics, but is extremely adept at many other things. And as I say, we've got a brief presentation which we'll go through in a moment or two, but the idea of this is that it's as interactive as possible. And so any questions you have, please pass them through. Without further ado, over to you.
Thanks, Andrew. Look, it's really great to have all of you with us today. I know we've got people on Zoom, on Facebook, and on YouTube. So if you have any questions, just pop them in and we'll get those questions through to us. So we thought we'd just give you a really quick update. But before I do that, I just need to give you a disclaimer that this is for general information only, that it's not personalized financial advice. And if you do need that, we urge you to get independent financial advice. If you need any of the additional information, our disclaimers, etc., are on our website. So I think there's a couple of things that we want to get across today. The first was just around what's been happening in markets. And Andrew, chime in with your comments on this one as well. I mean, it's been a stellar year. Earlier this year, we had the kind of volatility with Trump. You can see that around early April when we had Liberation Day. But since then, markets have been on an absolute tear. And you can see that both on the picture on the right-hand side and the returns across the last year, across all the big metrics that we look at across New Zealand shares, global shares, and bonds. Any comments on that, Andrew, before I move to the next?
No, not really. I mean, just that, as you say, since that Liberation Day, the sort of, as you say, extreme volatility that we saw very briefly, markets have just taken a view that, to a degree anyway, that's all a sideshow, and that the US economy in particular is continuing to produce extremely strong results. Hence the share market.
And I think there's also the belief that the tariffs that Trump announced would not be fully implemented. And I think we're seeing a bit of that. They've always been a bit touch and go. But even yesterday, we saw some of the tariffs have been reduced, which will benefit New Zealand specifically. But also just a bit of context, close to 20% return on, over 20% return on equities in a year is an extraordinary result. So it's equivalent of many years of usual returns that we expect. And if you kind of take a sort of a step back and look at what's happened over the last decade, I think that really kind of puts it in context. You can see on the left-hand side what's been happening in the fixed income markets, and that's kind of Andrew's area of expertise. Andrew, do you want to just describe what happened through that period? Because there's quite a lot that happened in the last decade.
Sorry, Chandra, you were cutting out.
Oh, I was just describing that in the last decade, we've had quite a lot of volatility in these returns with significant reductions in interest rates and then the big increases after COVID.
Is it just my connection or are you through?
I'm hearing everything okay.
Something here says my internet connection is unstable. I'm going to need tech help.
I'll keep going.
If you can hear me, okay. I mean, essentially, we had the bond. Sorry, Jen.
You can't hear Shamubeel?
I couldn't hear Shamubeel.
I can hear Shamubeel.
Oh dear, sorry.
Everybody?
Yeah, so apologies everybody. We're having a few issues, but
this is why I'm dialing in from home, where I've got very fast internet, which works really well. But let me push on. But if you also look on the right-hand side, you can see the growth assets in terms of shares, both New Zealand and internationally. And you can see that global shares have done extraordinarily well in recent years. New Zealand shares less so. And you would have seen that just generally that our market hasn't performed as well as the international markets. And I just want to touch very briefly on what's happening in the New Zealand economy. Things still feel a little bit glum in terms of confidence. Things are still not as positive as I would have hoped after the interest rate cuts from the Reserve Bank. And you can see that on the left-hand side, on the green line, is what people are saying about their personal finances. Those are still kind of pretty negative. And a lot of that's to do with the high cost of living, particularly for things like food, insurance rates, those kind of unavoidable costs that have gone up a lot. And the relief from interest rates hasn't been as broad-based and as well felt as we had hoped, but it should be coming over the course of the next 12 months. On the right-hand side, you can see with businesses, they're kind of very optimistic about the next year, but current conditions are only marginally better than they were this time last year. Some signs that things might be bottoming out. So both on two kind of key metrics. When I look at net migration, because it kind of provides such a big cycle to New Zealand, that seems to have bottomed out. It's still looking pretty low. So still lots of pressures of the New Zealand economy not doing as well as Australia means that we're losing lots of people to Australia, and we're not seeing the big inflow of people coming into New Zealand. And on the right-hand side, you can see what's going on with job ads. That's a really good kind of leading indicator of how people are feeling about the economy. And you can see job ads are starting to just pick up from very low levels. So it's still very early days, but a lot of the feedback I'm getting from the online job sites, from HR people, is we're starting to see a little bit of interest coming back. So those are kind of good signs that the New Zealand economy at least might be at the bottom. A couple of things. We've got the Reserve Bank that's still cutting interest rates. And I was on a webinar recently with some other folk. And one of the things we talked about was when the central bank wants to create a recovery, they will get it. They will keep cutting interest rates until they have engineered that recovery. Just like they engineered the recession we've just experienced, I think the Reserve Bank will keep cutting interest rates until they have reflated the economy. So I'm feeling much more optimistic about next year. And the other reason for cautious optimism is we've got an election year coming up next year, and government's likely to be less serious, I guess, about austerity. So at the moment, the forecast that the government is going to be cutting back on spending a lot in coming years. But with an election coming up, with the polls where they are, it's very likely that we're going to see many of those decisions being delayed in terms of cutting public expenditure, and which at the margin will mean the economic cycle should be more assured of a recovery than might have been the case. Now, some of the questions that we've been getting ahead of the webinar today has been very much around what should I do with KiwiSaver and those kinds of things. And the reality is that while we can't give you tailored financial advice, we can give you some of the kind of high-level ideas that we've talked about before. And these are kind of the three choices that I think about a lot when I think about my KiwiSaver on my investment choices. It's those kind of three big questions that we ask ourselves, which is firstly around, who's your provider? The second is, have I got the right fund for me in my stage of life? And there's lots of really good material that's available. But also, if you get independent financial advice, that's very useful. And then the question is around how much do you contribute? And the reason for that is, of course, while it's very easy to kind of think about markets going up and down, if you think about what actually creates long-term wealth, it's very much that habit of saving regularly and the power of compounding over time. So, nobody can predict the future, and certainly not when it comes to markets, but that's quite useful. So I think this was a little mind map that I had created after the budget when a lot of the KiwiSaver policies were changed. And some of these might still be useful for you to kind of think about in terms of the questions to ask yourselves. The first question for me is like, is KiwiSaver the right thing for you? For some people it is, and some people, they might need other things. And if you need other things and you have the capability and ability to save, it's really important that you get good financial advice, whatever that might look like. But it's also making sure that you're maximizing the entitlements that you do have KiwiSaver. And as I said before, the questions, once you've got into that through that filter, is less about, I guess, those rapid changes in the way that you save. It's more about those big questions that we ask ourselves around, have I got the right scheme? Have I chosen the right fund type that's right for me in my life stage and my risk appetite? Am I contributing the right amount? And do I have the opportunity, the final one, to save in some other ways? Because my kind of workings show that for most people, KiwiSaver is really, really good to set you up for a start of a good retirement. But if you save something on top and you have the capability to do so, you'll have even more choices in retirement. So those are all the kind of prepared remarks I had. Andrew, is your internet back on?
Seems to be working better now. Apologies for that.
All right. Good. So look, we've already had a whole bunch of questions that have come through. So I wonder, Andrew, if I should read them out and we start those and people will put their questions into Q&A and we'll address them. So the
Perfect.
first question is from Julian. He says, "Hi team, I'm really impressed with your KiwiSaver and investment products. Also the fact that you are building homes for long-term rental and now moving into infrastructure. Do you have any plans to offer regular bank accounts in the future? I wish that you would."
It's an interesting idea. It's probably outside of our target market just for the moment. I wouldn't ever say no, but there are obviously things like capital required, etc., which as a not-for-profit is quite difficult for us to do. But with open banking, who knows in the future whether we can offer something akin to a bank without actually having to be a bank ourselves. So we'll keep an eye on that one, Julian. Thank you very much for the support.
Yeah, it's a hard one because banking is quite a technical and expensive business to be in. The second question is from Jason. Are you worried about the effect and flow-on effects of the current AI tech bubble popping, which feels like it will inevitably, some stage soon? How heavily invested are Kiwis in these companies like Nvidia that seem to be way overinflated at the moment?
Yeah, I'd like you to chip in here with your thoughts as well, Shamubeel. But the AI bubble, it's a really interesting one. It's obviously front of mind for a lot of people. The market had a bit of a conniption last week. And as I say, it's something which gets discussed a lot. From my perception, AI is an extremely powerful development, and it's very difficult to predict how and where and who it's going to feed through to. But it clearly is a big change to the environment, and I think that's why it's caused some of these tech companies to perform as well as they have. It's just how many of them are going to be able to take advantage of it and who. So, I mean, just going back to the particular point about Nvidia, I'm always interested in these things. I mean, it makes up 6.7% of the global index. So our global share funds have 6.7% basically invested in Nvidia. It's one of the biggest holdings. But it does mean that if you're in a balanced portfolio, you've actually got less than 3% of your portfolio exposed to Nvidia specifically. And the thing about a company like Nvidia is that it is actually it's not like the dot-com era. It is actually making significant amounts of money, and appears to be in the box seat for now in that particular sphere. So, and we don't make calls on stocks. We're a passive manager when it comes to these things. And it does make me nervous, of course, that where we do have a relatively high concentration in some of these stocks, but it is actually quite a small proportion of your portfolio. The companies are profitable. Shamubeel, have you got any thoughts?
Well, I was going to reflect that I've been working since 2001, so I've been through a couple of these kind of market corrections, and my experience through it is you can't pick the cycle. I think the worst thing that I have seen is people selling out at the bottom of the sell-off and locking in those losses. My personal experience of investing through the GFC was extremely painful and frightening at the time, but the fact that I continued to contribute through the time meant that my overall savings position is very good as a result of staying in the market even through that period. So I guess it's really a question of how do you want to think about it? Do you want to time the market, or do you believe that kind of the wider view that we can't predict markets, and rather than trying to pick these things, focus on what you can control, which is about those regular contributions, that habit of savings, and ride out those cycles as they come. So for my short-term savings, I saw many of those things disappear during the GFC, but that's what happens through these kinds of market events. So personally, what I'm doing with my money and our family's money is we continue to save regularly, and I think that's the right thing to do at my stage of life. where there's the right risk appetite. And I think that's the same question that applies to people. It's almost what's happening in AI and what's happening in market valuations is a little bit of a sideshow that's at the margin. What I'm assuming is that markets on average over time will give me, that close to that 7% per annum returns. And that is what's going to set me up for retirement, not trying to pick markets.
Yeah, no, well said. Well said. I've been through a few more cycles than you, and yeah, that's absolutely the case.
A question from Mary Ellen. How likely do you think it is that some combination of AI as a technology or a bubble, tariffs and their effects on trade flows, growing populism, authoritarianism, climate change, and changing population demographics, or something else could break or severely disrupt historical patterns in financial markets? And if such a break or major disruption were to occur, what do you think the most likely cause and effect would be? Oh my God, that's a really great question. We could write a PhD thesis on that one.
Yeah, very much so. Yeah, and obviously, there's always a chance that will be the case. I guess we come back to, in my mind, again, very keen to get your thoughts, Shamubeel, but the stock market, let's say financial markets, are just a reflection of almost of human endeavor over an extended period of time. And so unless something is going to happen which causes us as a race to cease to grow and companies to cease to be profitable, for the economies to turn into nothing, then financial markets will continue to reflect that. I just think that we've got to have effectively faith that that's the case. I mean, if you any
Oh, look, I mean, my view is that financial markets, like you say, incorporate the good and the bad, the information that's available. But it's also a survivor's market. So what we will see in financial markets are businesses, even in those change conditions, are able to make money. So the reality is that if you look at the composition of the share market today compared to 100 years ago, they're very different things. But being invested in the market, or the share markets, have shown us the changing composition of the economy and who the winners and losers are within that context. So I don't know if financial markets break, but in terms of being able to predict returns or whatever, sure. I think I've always thought that it's unpredictable, that you can't rely on historical patterns to predict the future.
Not sure.
There's a question from David here around the Infrastructure Development Fund. So David says, hello, there are a couple of questions I'd like addressed around the proposal for an infrastructure development fund. What contingency plans are there around the risk of regulatory interference that would hinder the market? For example, were it mandated that all infrastructure planning and procurement must include government, so the fund becomes caught up in the thing that is government procurement and project management? Is there a recovery or market exit or some other plan? And the second question is, will you offer investment funds that exclude the New Zealand Infrastructure Organization from holdings? Can I answer the first one there?
Far away.
Mainly because I've been quite involved in that stuff. So when it comes to the infrastructure fund that we're looking to develop, and it's still something that we're looking to develop, we would like to put assets into it that are already operating rather than the development of it. So not the design and build part. And so, yes, you're right that there is always regulatory risk with infrastructure and assets like that. But what we would like to put into that fund are assets that are operating, or assets that have incomes, and that is backed by contracts, to essentially exclude ourselves from some of those political and regulatory risks that David is talking about. The second part of the question, Andrew, was, will you offer investment funds that exclude the New Zealand Infrastructure Organization from holdings?
And I think, I mean, there will be, but there won't be diversified funds. The idea of this entire initiative that we've taken is to create a vehicle which has extremely good long-term stable cash flows and values. It goes up with inflation, it goes up as the economy grows, and therefore why wouldn't we include it in our funds? It's open to some discussion, but I mean it's likely to be under the category of other, and therefore because it's going to have characteristics of both the income side and the growth side of of the asset classes. But as I say, provided it can find and own the assets that we believe are out there and are attractive, then I think we will want to include it in all of our diversified funds. It's just and the proportions again will probably depend slightly on exactly what assets the business is able to acquire. So I don't want to be evasive about it, but it's still fairly early stage, fairly early doors, as Shamubeel said. So until we know a little bit more about the composition of the fund or the business, it's hard to answer definitively.
Yeah. I have a question here from Diego. My partner is considering investing in a managed fund. What are the best arguments for and against that? And what do you recommend on balance and why? We can't give personal recommendations, Diego, but what I'd say is that the significant amount of inflows into Simplicity at the moment is in our investment funds. So not KiwiSaver, but the managed funds. And people are choosing to save their additional savings into a managed fund type product, including like ours. And the reason why they're doing it is because they have decided that they have a particular type of risk exposure that they would like in that investment. So I think the questions, Diego, you might want to think about are exactly the same as when choosing a KiwiSaver. Can I afford to save? And if so, what is the risk appetite for my life circumstances? Question from Shane. I have two questions. In an inflated market, is it better to be in a balanced fund than a growth fund? And is an actively managed fund going to be able to hedge its losses where a passive fund will be less able to defend its investors? It might be best answered by you, Lance.
The real debate about active passive is one of the most interesting ones to have with people, and to a degree, there's an element of you either believe or you don't believe. From our perception, and the reason we set our business up the way we did, is that we believe that active managers overall tend to underperform the market, and therefore we're just best having a broad spread, an extremely broad spread of investments, and being consistently invested. If you believe active managers can pick markets, then possibly you'd go with that. As we say many times, we can't give individual advice. We can't give advice. A balanced fund is, a balanced fund is exactly that. Over an extended period of time, you would expect growth assets to perform best, and therefore being in a growth fund or a high growth fund is better for you for your very long term well-being. But over a shorter period of time, having more income assets, which is basically bonds, just gives a more stable return, just not quite as high.
Exactly. I think, again, that's exactly the question that we talked about in our family is what's the right kind of risk appetite for us to have in the way that we save. And hopefully we've got 20 plus years to still save. And so if that's the case, then it makes sense for us to have that savings in a relatively aggressive thing because we've got other things like property that are less risky in some ways. Okay. There's a question from Ina on YouTube. What fund should I choose at 55 years old if I want to leave my funds working until I'm 67 years old? Thank you.
We can't give advice. It's frustrating sometimes. All I would say is that the tools on either our website or sorted.gov give you a series of questions to answer that then lead you towards the type of fund that you should be. It's all about risk tolerance, time, and your as I say, your ability to ride out the short-term volatility.
Yeah, so I think the website is sorted.org.nz, and it really is very helpful to get you started. It also has a really good tool for you to be able to find a financial advisor should you want. And so it's quite helpful for you to have a little play to get a sense of what might be right for you. But also you might want to think about what your money will be doing once you retire. So you might retire at 67, but what if you live till 94? You've got a lot of years for that money to be used, and so you might want to think about how you might look after different tranches of that money over time. All right, so there's a question from Cassandra on YouTube. Just a follow-up from a prior webinar where it was suggested KiwiSaver was going to enable a split of funds across programs. Any advance, e.g. split between balanced and growth?
Yeah, I'm sad or slightly embarrassed to say no, we haven't made any progress. We've talked about it. It's been mooted. There is an element that because we have such a range now of funds, really all you're doing by splitting them is recreating something we've got already. But I've got to know. In fact, there's a question on come through on the Q&A through Zoom as well from Tony. Thank you, on exactly the same point. So I will take that away. I will take another note to say let's come back with something definitive.
Excellent. There's a question here from David Smart. What early trends or signals are you noticing in the New Zealand economy that most people aren't, but that you think will have a major impact in the next 3 years? And what makes you confident in that view? Wow, that's a really big question, David. I'm not sure I have a very strong view on what will drive New Zealand in the next 3 years. I guess in the short term, it's very much a story around what I think will happen around monetary policy. I think the central bank is going to play a really big part in reflating this economy from the current recession. In terms of the longer term outlook, the kinds of things that I'm thinking about are really around those bigger systems issues. Are there ways that our political system is going to be able to provide stability in a world that has become unstable? So we're in a very kind of interesting fork in the road, I think, in terms of how we do politics and social stuff in New Zealand. And if we are able to find a way that has a little bit more consensus than our trading partners and international peers, I think that will set New Zealand up in a much better position to, I guess, create economic prosperity for more people. So I'm not saying it's a prediction, but I guess that's the scenario that I see would be really positive for New Zealand going forward. A question from Cassandra on YouTube. Why does Simplicity choose to be a passive manager, and what are the risks?
When we started out now over 9 years ago, we did some work on whether active or passive was best. And most of the studies, if not all of the studies, say that over the long term, passive beats active, partially at least because active managers charge higher fees. And they can't justify those fees when you look at those returns over the long term. We also looked to a gentleman called Warren Buffett, who puts most of his money in passive, as a guide to whether it was a good idea or not. So it's as I said earlier, it's almost a philosophical thing. Some people believe active management can add value, but the number of active managers who do add value is extremely limited when you do studies across a broad enough investment universe. And the key from our point of view was, therefore, if we could offer a really, really diversified products at the lowest possible fee, that would be in the best interest of our investors.
Yeah, Andrew, I was quite involved right at the beginning when Simplicity started, and those were the conversations we had around the table quite a lot. And I think the thing that stuck with me was there'll be managers who do a great job in certain periods of time, but it's the ability to do so consistently that's hard. So if you think about some of the famous people who have shorted markets and made lots of money, they've probably predicted 20 of the last 2 market crashes. So they're a little bit like economists in that instance, aren't they? And we have predicted more recessions than have happened. So look, it really is a personal preference thing. So based on, you do have to make a personal choice around whether you think that's the right thing for you. And that's why that question around what kind of scheme you're in, what kind of fund you're in is so important to ask yourself. Are they consistent with your beliefs on, I guess, the ability for managers to add value consistently over time? So what we offer, of course, is that hands-off approach at low cost. Those are the things that we can control. You can't do both. I'll take some questions from the Q&A on Zoom. A question from MM1. How do you feel about a lot of the S&P 500's growth being driven by the Magnificent Seven AI companies?
Is that me or you? I mean, as we said before, the companies we're talking about are at the forefront of markets. One of the things which I think it's important to remember is that those companies are not just US companies. The vast majority of them, if not all of them, are global companies. So the concern about having quite a lot of money invested in the States, which is understandable, from my point of view, is at least alleviated by the thought that, as I say, the companies that we're talking about are generating their income globally. They're not concentrated purely in the US. As for the Magnificent Seven, as to say, the reason that they have got to the size that they are is because they're dominating, and we're not in the game of trying to predict when that might change.
A question from Rosie. Any thoughts or predictions on what will happen with the next few OCR reviews, and how will that affect the New Zealand share market? Good question. I can give you my kind of take on what the Reserve Bank might do. Been wrong plenty of times before, so maybe take it with a sack of salt. I think there's at least one more cut from the Reserve Bank because they really do want to create the recovery. Whether or not that will affect the New Zealand share market, if you look at the correlation between OCR cuts and the New Zealand share market in the last 10 years, it's not been great. And that's partly because the types of companies that are in our share market are very much kind of income as a producing market. So it's not a good reflection of the economy as a whole. It's a very kind of stilted view of the New Zealand economy. So I've not been of the strong view that you can play the OCR calls with the share market in New Zealand very easily. But Andrew, do you have any takes, any other thoughts?
No, not at all. No, I mean, in terms of the OCR, another cut does seem to be very widely priced in. Beyond that, though, certainly from the market's point of view, there's no further cuts. One more is basically it.
One more, exactly.
But whether that does prove to be the case is obviously open to debate.
Good. Another question from Rosie. How much is AI used to decide what shares to invest in? Oh, even I can answer that one. We don't use AI at all in picking shares because we don't pick shares.
No, we don't. I believe there are now managers using AI in their decision-making process, but I don't think there would be any in New Zealand that are likely to be doing that for New Zealand shares because it's just too small a market. You don't need to.
A question from Goldie. Simplicity is investing considerably in affordable housing. What is the risk that the very laggy market demand is mistimed, such as seen in China and previously in Ireland? How does Simplicity know the demand and therefore return will be strong? Over the long term, this might be okay, but what about your clients who are closer to retirement and are more exposed to shorter to the medium term? Will this strategy give the best return possible? It's a really good question, and I guess that's part of the reason why we've been so focused on Auckland, where there is quite a significant shortage of affordable rental properties. And with the same reason that I think we've decided to try and develop new things in Queenstown, because there's a real shortage of affordable properties there. There are two things that are making us, I guess, comfortable with our investment in the living space. First, the development margin that we're able to generate for our investors. Because we've got a vertically integrated developer, we're making really good returns on the development side of things. And the rentals, hopefully, will be at least consistent, if not spectacular. So that's really the kind of the mix that we're trying to create in terms of that. Will this be the best strategy for everybody? Probably not. And I think this is the earlier thing about making sure that when you're choosing your funds, if you're choosing the specific funds when you're saving, make sure that it's consistent with your life stage and your risk appetite. Does that?
Yeah, I think the only thing I'd add, Shamubeel, is almost reiterating that the strategy is designed for a really good long-term, much like the Infra Kiwi initiative, actually, good long-term stable cash flow. We're not trying to shoot the lights out, as you say, the development margin that Simplicity Living has will generate decent returns, but we're not looking to do anything spectacular. It's another relatively conservative investment from our point of view.
Question from Anonymous. What are your thoughts on the property market? It is very expensive for those living in Auckland, and sometimes it seems better to rent and invest the rest. Do you have any ideas for the future bank rates? I understand you can't provide specific advice, but I appreciate your intel. Look, at the moment, I can tell you what I'm experiencing with my kind of own experience. House prices in Auckland aren't doing very much. They've in fact come down quite a bit since the very big highs that we had during COVID. And the rental market in Auckland at the moment is relatively soft. In fact, rents are falling in Auckland, which happens very rarely. And the reason why that's happening is because we've been building a lot of homes and population growth has slowed in recent months because of that slowdown in migration. But in terms of your particular situation, I think, again, that financial advice might be really useful for you to think about your options that are in front of you. And the reason I say that is because you almost need to compartmentalize what you do in terms of the home that you buy, which is, I think, not an investment, but something that you want for stability and other reasons, and the savings that you have that are gradual and regular over time that hopefully sets you up for that long-term financial stability. And those are, in my mind, slightly different choices. So I think rather than trying to be too cute about trying to pick things, it's about being really clear about how you want to live, whether you rent and if you can't afford to own, what you do, and how you save. Because if you want to buy in the future, then you need to save now to be able to save your deposit. If you don't want to buy, then you really need to think about making sure that you're saving for retirement, because you're going to need that money for retiring and for the housing costs of the future.
Well, the next one I've got is from Rob. From a funds management perspective, 2.7%, I suspect we're talking about NVIDIA, is big. What about adding a simple max of 1% per share position? In this case, you would, in essence, crystallize the gain on the 1.7. We wouldn't be being a passive investor if we start putting caps on exposure size. Historically, that would have been extremely detrimental to investors' returns if we had. As I say, those companies have got to the size they are because they have been growing and generating the sort of profits that they have as well. We're not going to start putting caps on stock size. It is a possibility. You've then got to decide what stocks you're effectively going overweight relatively, if you're going to start doing that. So I think overall our view is simply stay the course, and sure, 3.7 does sound, or 2.7 does sound like a relatively high exposure, but you've got an awful lot of companies in there, and it's just that one's been one of the more successful.
A question from Anonymous. Hi, Shamubeel. Follow up on that question, what assets will be held in the infrastructure fund? Can you give examples of the types of assets that are operational, income producing, and backed by contracts? Sure. A good example would be the electricity distribution networks. So many of them are held regionally, either through community trusts or through private companies. Those are really good examples of companies that have regulated returns, and those, I guess the security of that is backed by contracts. But there will be other things that we'll be considering as well. And like we discussed before, it's still very early days, but the kinds of assets that we have thought about are things like toll roads, things like own and manage, operate contracts for public buildings like hospitals or schools. It could be things like what else? Storage facilities in regional councils or water meters. So there's quite a wide range of things. And right now what we're doing is we wanted to announce that this is available. This is something we want to do. And we have been having these conversations with lots of people around the types of assets that might come into it. And we will continue to explore to make sure that we find the right ones that goes into these things. So for example, you'll know that New Zealand already has a listed infrastructure company, investment company called Infratil. It invests in lots of different things from data centers to airports. So, there are I guess, a lot of different examples of the types of infrastructure assets that might fit. I think this is a question for you, Andrew. What is the predicted return for the growth fund?
I hope that noise of builders is not interfering too much. Predicted return. All we can use are the returns under the regulations, and I think a growth fund's long-term return is 6.5% after tax and fees, is what the regulations allow us to use as a proxy. Essentially, we don't know, but we can always provide long-term historical numbers, but we can't predict what are we doing in the future.
There's a question from Mariana. Is 15 years considered long-term reinvesting in growth fund?
Again, I've got to try and remember what we're, if you like, what we're allowed to say. I mean, fundamentally, 15 years should be plenty of time in a growth fund. It would be an extremely unusual period in history if growth assets had not gone up over a 15-year period. So I think the answer is yes, but that's not personal advice, of course.
Yeah, I think it's really worthwhile, Mariana, to maybe use the sorted.org.nz tool, because that does help you kind of ask some of these questions and query the assumptions that are behind it. That might be a really good first step. And as I've said before, and if that's not enough, talking to a financial advisor would be really useful.
The next question is my favorite subject. The last few financial crises have happened roughly 10 years apart. The way I understand these crises were mainly based on large organizations speculating on money that hadn't been earned yet, like futures, etc. Now we have crypto, which I think is more money that isn't really there. I know we are seeing phenomenal US share returns, but is this just the beginning of the next crisis? The question on crypto, as you can imagine, comes up many times. I'm a boomer and therefore very skeptical, but accept that there must be something to it. I don't know if you've got any words of wisdom in this one, Shamubeel, but from my point of view, there are lots of different aspects of the financial markets at the moment which concern me slightly, and crypto is probably the greater of them. I'm personally less concerned about AI. That, as I say, that those companies are the companies that have performed well are actually making quite a lot of money, or most of them. Crypto's a very difficult one to talk about. It's not something we invest in. Shamubeel, any?
Look, I mean, beyond the fact that you don't see a bubble until it's popped, right? So until it pops, you're just losing money by not participating, not being in the market. So the way that I've thought about it, like I answered it before, is we can't predict what markets will do, and if you can't predict it, what can you do that's within your control? And in my mind, it's really very much about making sure that you focus on the things that are within your control. Yes, we do see some similarity in terms of crises, but the reality is that no two market crashes are the same, no two bubbles are the same. No two bull runs are the same, and they all have different kind of causes and ingredients. So I don't know, like when I was studying for the CFA, this was one of the things that you had to kind of go through and try and answer in your essay questions. And I don't know if that was the essay question I got a good mark on or not, but the way that I had described it during that was, if you're trying to explain it to a saver in terms of these markets, you have to ask them, if you can't predict these things, what can you do? What can you focus on that gives you control and gives you some protection? And I think that's really the thing to focus on. The next question, I think maybe, Andrew, is for you, from Martin. Where do investments in simplicity living sit on the active, passive, low fee spectrum?
Okay, well, I mean, in terms of the fees, there are no fees, so there's certainly low fees. The way that investment is structured is that, as I say, there are no fees. The active passive question is an interesting one, really, because technically it is an active decision that we've invested in Simplicity Living. It's not passive in the sense that we're not copying anybody else. we see it as I said before, as a sort of long-term, good, solid investment. That's the type of thing that the pension funds should be investing in. It's, as I say, it's long-term and should be capital pretty stable. So I suppose, we have to accept that we are, and we now use the term predominantly passive. We are passive in the investments that we make broadly through financial markets, and we've taken a few positions in areas where we believe the market is either mispriced or that there are assets that we can buy which are going to create the best returns for our investors over time. And that's where we've got a small amount of money invested in private equity as well. For exactly the same reason, we believe there are good returns we made, particularly in New Zealand, out of private equity investments. And so far, that's proven to be very much the case. In terms of Simplicity Living, that was once again just a chance for us to take a position in an asset very suitable for the investors that we're investing the money, whose money we're investing.
The next question is from Rob. Please give a view on your hopes for Dr. Anna Brennan as the new central banker. I heard a presser last week that was pretty critical of Adrian Orr and the unnecessary recession. Look, it's very easy to be critical in hindsight. I guess my hopes for the new central banker is that she has a lot of experience overseeing competition in the banking sector. That's probably where I would see the most kind of optimism in terms of monetary policy that's done by committee, and it's unlikely that we'll see a major shift just because there's been a change of the top person. So look, I think the opportunity here is really around what happens around open banking and around banking competition. I think one that the new central banker governor has quite a lot of experience in. The next question is from Tony. Thanks for considering the option to split KiwiSaver contributions between fund types. In a volatile market world environment, if KiwiSaver is your only or major asset, it means you would choose a low risk fund or move up to 100K into a bank account that is guaranteed by the government. Split funds would encourage keeping funds in KiwiSaver because you could protect what you have in a low risk fund, but also get the potential growth in a high risk fund. Is this correct?
Well, I mean, yeah, Tony, yes, it is correct to a degree. The only point I'd make, which is sort of why we haven't rushed to do this, is that if you actually invest in a balanced fund, then you've got roughly 50% of your money in low risk and 50% in higher risk. But splitting, I can understand. I can from a, if you like, philosophical point of view, I can see that having some money sitting there, you know that it's safe in our defensive fund, and then having some in a high growth fund would I can see that does make some sense. So we are taking it on board. Somebody has said in one of these that we are concentrating on KiwiSaver members. I mean, that's of course very much the case here, because if you are non-KiwiSaver, our investment funds, you can have any spread of those you like.
Thanks. Question from Heather. You have mainly concentrated on KiwiSaver members. We were KiwiSaver members, but now have switched over to your investment fund side. Thank you, Heather. So we can access our money. However, because we are retired, we cannot access mortgages, even though we still have income from rental property. Would Simplicity ever consider some kind of reverse mortgage product to address the issue that we and others are experiencing, accessing money to supplement our pensions and rental income? I know there are banks out there that offer this product, but the values and ethics of Simplicity are aligned with mine.
Yeah, thank you, Heather. It's an interesting question. It did come up some time ago. We had a product as well that was sort of designed to assist with that sort of thing.
It was Lifetime, wasn't it?
Yeah, that's right. Yeah, again, let me take that away and think about it. I mean, reverse mortgages, as you said in your note, they are offered by some entities. I don't know that any of the banks do.
I think Heartland or SBS does.
Yeah. Okay. So yeah, they're banks. Yeah, it's an interesting one because from philosophically, yeah, I struggle with it a tiny bit, only because if you take out a reverse mortgage, you use up with all the equity in your house. I don't want to be the person required to sell the thing at the end of the day. But yeah, it's something which I will take away and think about.
I think there is a broader question that Heather's asking, which is around the retirement income part. So much of our savings industry has focused on how do we get people to save for retirement, but how we convert that into retirement income in retirement is not something that's been fixed yet. So we're not the only ones, Heather, that are struggling with this issue. So this is something that Rosie and I at our research side have been thinking about a lot, which is around how do we create annuity products and other things so that our retirees aren't sitting with that lump sum that's really hard to manage. But what you really want is income in retirement. Can we create something like that? In some other countries, there is a mixture of ways they do it, either through regulated assets or guaranteed kind of returns over periods. There's no one perfect model, but it's something that we're thinking a lot about. So this is an issue that's prevalent right across New Zealand. We don't have good annuity products. And that's something that used to exist a long time ago, but they've really struggled because of various kind of issues, including through regulatory issues. So look, we will ask this question. We will think about it because you're absolutely right. There is a real need out there for those who are retired to have access to products that suit them. A question from Anonymous. Do you employ your own financial advisors or do you refer external advisors to your clients? If they're external, do you pay them commissions for their advice?
I like questions I can answer. Thank you. It is a good question. Yeah, no, yes, we do have some advisors that we recommend people to, but by definition, they charge you a fee. We don't get any. There's no commission paid to us, and there's no. They are advisors who, as I say, they charge their clients commission. They don't get trails or anything from the people that they put their money with. There's a group there. Trying to think how I can direct you to them, but if you pretty certain there will be something on our website that would be able to point you to them.
Yeah, look, there is a really good tool on the Sorted website to find a financial advisor. But if you're really struggling and would like to talk to somebody who's independent, who we are not compensated by at all, drop me an email. I'm very happy to kind of make an introduction so you can get started. I actually did that with my neighbor the other day. He came along and said, I really need some financial advice. I said, I can't do that. But here is a guy I know who I trust because, he's quite independent. He's been around for a long time. And I know that, at least the first conversation will set them up. Okay, a question from Anonymous. Maybe a bit of a silly question, but can you explain the difference between your high growth and growth funds?
It's not a silly question at all. Put simply, the growth fund, which has been in existence since we started, has a small amount, 20% roughly, invested in income assets, which are less volatile, bonds, fixed interest, etc. 80% of its assets roughly are in shares, whereas the high growth fund has no income assets at all. It is purely in shares, one way or another.
Right. A question from YouTube from Director H. Congratulations on reaching 10 billion under management. Are there any other plans that are triggered by reaching this goal? Don't ask Sam to invent anything new.
It's exactly what I was thinking. No, I think things like InfraKiwi and that in particular is probably the one sort of new idea which is being worked on. So no, nothing in particular triggered by the 10 billion.
Great. A question from Ina. What are the chances of using my KiwiSaver funds to buy a first home if I still have a very small section land on my name overseas but not mine?
I don't think you qualify under our rules. I need to check with the team, but I don't think so. I think we've made it very clear that if you own any property, you don't qualify. We are refinancing people in their existing home as we speak, so that we've already loosened the original rule very slightly. But
I think
Um,
that might have been around being able to withdraw KiwiSaver for the deposit,
right. Yes.
which I think you cannot, but I'm not sure. So it'd be worthwhile giving our friendly services team a call just to work through
Yeah.
this.
Or and the email address for the investor services team is info at simplicity.kiwi. They'll be able to refer you to the team who would be able to be definitive rather than us fluffing around.
That's it. A question from Alex. Do you have any plans to have non-ESG global share funds? I believe your current global share fund at some point is excluding Amazon Meta with very limited reasoning from the index provider.
Um, yeah. So I mean, in fact, our global funds have always been, they very, very briefly weren't, but have always been screened for a few things. They, but there's no plan to produce unscreened funds. No. Meta is always an interesting one, but it comes up in conversation very often. But no, there's no plans to change what we currently do.
Yeah, so Andrew, I think the way that we do it is there is a screen that is done for us on a basis of a few things like no gambling, no cluster bombs, things like that, and we take the screening that's provided rather than try and change it ourselves. Is that correct?
It's fundamentally, yeah. So we use a company called Sustainalytics to screen our international share funds, and they have a series of categories which they for various different activities, and exactly we use their reasoning. We just don't have the resources to do it ourselves.
Okay. The next question is from Mariana. How do you ensure that Simplicity invests in ethical businesses? I guess it's very similar to the question we're just talking about.
It is, and I've again it's a slightly difficult point, but it's very important to understand that we screen out businesses. We don't directly invest in businesses that are specifically good. It's quite a difficult question to answer in a way, because what we're trying to do is make sure that we don't invest in bad, is the way I typify it. And again, we outsource that. We use an external entity to do the screening for us. And we're very clear on the rules that apply to what companies we don't invest in. But that also still means we're invested in thousands and thousands of companies. And people have opinions on a number of them, and they believe they are or are not ethical, whatever that word means. And it can get quite difficult. So from our point of view, as I say, we've set the rules. We know what the rules are, and provided companies comply with those rules, then we invest in them. It's not that we just invest in companies that we think are doing good stuff.
Yeah, we do it by exclusion. So we have one final question to answer from Heather. Oh, I knew Sam was going to get us into trouble. Sam Stubbs has said that everyone needs financial advice, but not many people need a financial advisor. Can you expand on what that means? Or did I get that wrong?
Are you looking at me, or am I looking at you?
We're looking at each other. Well,
Yeah.
let me start. I think what Sam means that for most of us, the choices for us are relatively simple. So if you go to the sorted.org.nz website and you run through your choices, it's relatively vanilla. It's only when you've got complexity in your life and a lot of money to deal with, that's usually when a financial advisor can be very, very helpful. I'm probably less negative about financial advisors than Sam is. I find independent financial advisors can be really, really helpful in getting your life in order. And so I do personally enjoy quite a lot the advice that my financial advisor gives me. I think that helps me make better choices. Any thoughts, Andrew?
Yeah, I mean, only that. I mean, I agree with you. There are some extremely good financial advisors out there. They do tend to only restrict themselves to relatively high balances, to a degree, because they've got to make a living themselves. But there are, as you say, there are resources like Sorted are very good. It would take a degree of complexity before you really need to go to a financial advisor, I think.
Absolutely. I think we've covered off all the questions we can answer, and it's been an hour. So I just want to thank everybody for all their time joining us in your lunch break. It's always great to be here. And the final thoughts from you, Andrew.
No, very much the same. Thank you very much, everybody. Thank you for attending. And as I say, our website, I've upset the investor services team and tell you again that if you do have any questions that we didn't get to, or that follow on, the website, the email is info@simplicity.kiwi.